Ladies and gentlemen, the panel is going to begin. Please come on in and take your seats. The panel is going to begin now.
See, you don't have an earpiece. You don't have an earpiece.
Which means I don't have to listen to any directors.
That's correct.
Lovely. That should be.
Thank you so much, everyone. We're going to begin our closing session. It's good to be here at Milken Institute's first ever Asia Summit. It's been a volatile 6 to 7 years since the implosion of the global financial crisis. Big lessons for Asia, big lessons for the rest of the world. What does it mean for Asia and its capital markets? To help me discuss today's closing session topic, strengthening Asian markets, allocating capital, refining policy, we have a stellar panel lineup. To my extreme right, Piyush Gupta, CEO, DBS Bank, based here in Singapore, Southeast Asia's largest bank. We have David Bonderman, founding partner, TPG Capital. We have, of course, this man needs no introduction, Mike Milken, Chairman, Milken Institute. And to my left, we have Lim Chow Kiet, Group Chief Investment Officer, GIC, and Jonathan Nelson, Chief Executive Officer, Providence Equity. Gentlemen, thank you so much for being part of this closing session. Let me first get you to kick off about the state of Asia's capital markets today. How would you describe where we are? Piyush, let's start with you. What are some of the insights you can give us as you lead Southeast Asia's largest bank?
Let me say this. If you think about the big picture on Asia over the next decade, I think we score really high on demand. And I'm not going to go into that. Everybody's talked about the massive opportunity, middle class consumption, and so on. I think we're somewhat challenged in terms of supply. You could argue China is too much, infrastructure, supply side, et cetera. You could argue India, Indonesia, too little, stuff needs to be done. But for me, the biggest challenge Asia will face in the next decade is the challenge of finance, of capital. And the reason for that is that our sources of financing, both bank, debt, and capital markets, are woefully inadequate. The banking sector, which provides the bulk of Asia's finance, is not big enough, is not capitalized adequately. Some back-of-the-envelope stuff we've done suggests that to finance Asia's needs in the next decade, there's going to be a capital shortfall of something like $500 billion in the banking system. And while you can raise capital, much of it is state-owned. So the Chinese is state, India is state, Indonesia is state. So the state's got to have deep pockets to capitalize the banking system. Not going to be easy. Within that, there's sectoral challenges, infrastructure, SME financing. There's some massive gaps. The public markets, they're moving, but they're fragmented. And the reality is, if you think about Asia's equity markets, market caps are small. They're not deep enough. And the debt markets, the bond markets, even after the 97-98 crisis, the government bond markets have started developing somewhat. The private sector bond markets are very fragmented. It's instructive. All of the bond markets in Asia, Japan, are $5 trillion. The US alone is $25 trillion. So there's a massive gap. In some ways, I think the stage is ripe for all of these gentlemen. Asia continues to be a great private capital market, a private equity market, for the reasons that I defined. So I think there are going to be challenges in terms of finding financing, but that obviously presents opportunities for private capital. My last comment, sir. It's instructive that these challenges are not because of lack of savings in Asia. China has $4 trillion of reserves. $2 trillion of those go out into US treasuries. Most of Asia's savings surpluses go out to the West. In fact, round trip from the West and come back to the East. So what that tells you is not really so much a savings gap. It's an infrastructure and intermediation gap, which we need to be able to address if you're going to get greater efficiency in this allocation of capital and putting it to work. So I'm going to stop there.
Okay, Chow Kiat, let me get you. You've got a close feeling of GIC, Singapore Sovereign Wealth Fund. You invest in companies here, primarily in emerging markets. Do you agree with what Piyush just said?
Sure, I think very much so. I think if you look at development of capital markets, you need three things. You need demand and supply, right? Asia does have a lot of savings and does have a lot of needs for the saving. And second, you need is infrastructure, right? Jurisdiction, all the legal stuff and the market structure to allow that. And then finally, of course, you need market participants, where local players in particular are very important.
Local players like yourself?
Like ourselves, like insurance companies, for example, pension funds and people like that. But actually, if you look at the development of GIC's portfolio, in some way it captures this challenge of developing Asian capital markets quite a bit. 3/4 of our portfolio is actually invested in developed markets.
That says a lot.
That says a lot, right? One big reason is because those markets offer the capacity, the liquidity for us to do whatever we need to do. Whereas, in the emerging markets, including Asia, we're not getting that kind of characteristics. So 10, 15 years ago, we started to move some money to the emerging markets, to this region. But I would say there is still quite a long way to go in terms of what we can do in terms of allocation of capital.
When you say moving money into these emerging markets, are you hopeful that things will change? Is that the view you're taking? That's why you're putting more money into emerging markets?
Yeah, I think generally we keep quite a positive view. But the big issue in emerging market now, I guess even for developed markets, is reforms, right? What kind of concrete steps are we going to see such that investors can participate in these reforms and get better outcome?
Let's get a non-Asia perspective. Mike, you basically change capital markets in the US. What are you seeing here in Asia that needs to change? What are some of the challenges you see in Asia's capital markets?
Well, in the United States, it was 40 years ago, really what I would call modern capital markets began in a need to the shocks that hit the US system in 1974. Interest rates doubling, stock market going down 50%, enormous unemployment. And that effort, the banking system had to focus on saving itself. It couldn't focus on its customers. Now, you had a chance for a dramatic change to be created after the 1998 Asian crisis, where companies were so dependent on the banks for financing. And so I think it's been said, Asia, and still to a great degree Europe, is financed by banks. The United States, after '74, we began to change the financial market. And the banking system actually decreased and shrunk in terms of assets in the 1980s. Both Citibank and Bank of America, which were two of the largest banks in the world, and at the beginning of the 1980s, Bank of America was not one of the 10 largest banks in the world, and Citibank had moved from second or third to 10th at that period of time. And so in order to shore up their own financings, they had to shrink the size of their banks adjusted for inflation. But the U.S. grew by the financing of public and private markets. And what's so unique in the opportunity in Asia that we see at the Institute is that the capital is here in Asia. And much of it is rooted back to organizations such as TPG or Providence or others in the United States or in Europe, and then often reinvested in Asia. And so what we think the change is, it's too much of a burden on your financial system and the lessons learned to have the banking sector finance it. The banking sector can serve a role, particularly as originator, doing due diligence, trader, creating markets, not having to put their capital up. And today in the United States, banks in the United States own less than 20% of bank loans. And so that is the opportunity here. We are extremely optimistic that you'll be able to finance Asia in Asia. In fact, ultimately, we see the ability to have Asia not only finance Asia, but Africa and other parts of the world. But you're going to have to create markets, and the conditions that are needed are obviously a rule of law, creditor protection rights, sophistication and creation of markets and trading of markets. Each one of those is required. So these markets need to be created. We had focused very hard between 80 and 86 on creating these markets in Japan, and felt that you couldn't have a system in Japan based on 10 banks or 12 banks supporting the system. What was so interesting is the people that resisted creation of markets in Japan were the banks themselves. They didn't want the competition. We tried to explain to them that they would rue the day that they didn't have a system to liquefy themselves in. And that things have been very difficult for the Japanese banks ever since. So today, the potential, DBS will be stronger in its potential if we had these secondary markets and could coordinate. And the purpose of conferences like this are to bring the individuals who are responsible for managing financial assets together with those that are responsible for managing industrial assets or companies. And so, to me, this is the challenge for Asia and the challenge for the financial system in Asia. And once it's in place, I think you'll find even more commitments by the Providence Capitals of the world or the TPGs and other here, because you'll be able to finance in this sector. The world is awash in liquidity. We talk a lot about central banks, but corporations have more cash than ever before in history. In some cases, corporations in countries like Japan have cash that is approaching 50% of the entire GDP of the country. Individuals are flush with cash. In the United States today, the percentage of the net worth of individuals in America has doubled since '07. And so whether it be institutions, whether it be individuals, whether it be corporations, we have to find a way to create markets here to match this enormous liquidity with the needs that have been outlined.
Okay. Let's bring in Providence and, of course, TPG into this, because you guys are already in Asian markets. What are you seeing here that you would like to do more of that you can't? What changes would you like to see? Jonathan, let's start with you.
Well, first, just the perspective of not an allocator from the top, but more from the bottom. So we manage a global fund, and while we have expectations about where we'll invest, and for emerging markets, for this part of the world, it's probably about 25%. But interestingly, it doesn't follow GDP or GDP growth. While we tend to talk about what's exciting in Asia is really about GDP growth, but what trumps that for us, because there's no correlation in a 5-year period between GDP growth and return on equity, which is what we care about, is specific opportunities that if we don't find certain requirements, we just move on because we're agnostic.
So what are those requirements?
So one is the area we're talking about is really financial sophistication, technology, the depth of the market, liquidity. And I completely agree with Mike's observations about what's here and where it's going, but it's not here yet. So there is a bit of a gap between opportunities and our ability or our willingness to seize them, because if there is no corporate bond market, which I think is vital for long-term investors, if we don't have transparency and predictability around law, which is creditors' rights, it's governance, it's bankruptcy law. Not every deal works out well, and some of them can be saved and prosper, but you have to move quickly through. You need a body of law to prosecute those reformations. And until we see that, that will stifle the investments we can make. And we're constantly looking out for that. An example that my guess is that David and firms like ours would face is that for dollar-denominated funds, foreign exchange risk is a huge burden on an investment because the same countries that are growing at faster rates tend to be the same countries that when you convert back, in our case, to dollars, the exchange rate hurts. And it's too expensive to hedge. So the answer has to be stability in FX, free transferability of currency, and that's a hard thing to do overnight. That takes consistent government policy. There was we've all seen the index about countries and how easy it is to do business there. And there's a lot of truth in that. I saw recently an index about uncertainty, an uncertainty index. That influences us because it creates such a cost and capital. It's easy to look at returns. It's much harder to look at risk. And we're in the business of risk-adjusted returns. So when risk is high, if we can't get those returns, we move to somewhere else.
Are you operating in any markets that you feel you have the right structure? Have you seen it yet, where the currency is stable? Have you been in that market here in Asia?
That's called Singapore, Christine.
Yeah, well, we've right now, I think what we're seeing is, for the first time, governments being very interested in attacking this problem, because the same countries that have current account surpluses are often the same ones that are behind. You know, countries don't develop uniformly across sectors. And the particular sector of financial services is generally lagging in development in those same countries. But we've seen it cut both ways, sometimes in the same country. For example, in India, where we saw the government enable a business that we follow closely, cable television, by mandating digitalization of cable, which eliminated piracy. It was better for consumers. We started investing. That's the same government that previously started handing out mobile licenses in a corrupt way, which killed businesses and discouraged us. So it's very hard to pick, on balance, we like India, but it's a complicated scenario that you have to constantly reassess. And what we're really looking for is predictability. We can have parties come and go, but what we can't have is new regime on taxes, and especially retroactive taxes. That's a killer. And countries that tend to have robust growth also come with it an uncertainty that, as we sit here, I can't say that there's if there was a graph that you want to be in the top right, high growth and predictability. We don't see that yet.
David, your view? Do you agree with what Jonathan just said?
Oh, almost always, never. No, I think the panel here has pretty much summed up the situation. As the anchor man here, I'll just make a couple of points. First of all, the financial markets in Asia are, if not in their infancy, they're maybe unruly teenagers. I mean, it's only been 15 years since a total meltdown across the region, and we're probably not going to see that again. We've seen some developing maturity here. We have a situation on top of the fact that the markets are feeling their way, as Jonathan said, differentially in different countries. And as Michael said, many of these markets do not have the rule of law as we understand it in the West, particularly on the debt side. That's a very important feature that's often lacking. But we've been through a period of time which suggests we shouldn't confuse the secular with the cyclical. And it's the case in all financial markets that when there's a perception of fear, as opposed to the greed side of the occasion, when there's a perception of fear, there's a flight to quality, and that has traditionally meant the United States. And it's certainly meant that in this last cycle. Whereas when people are looking for yield, and they have a little more confidence that they're not going to worry about preservation of capital, then you see capital flow out or stay into regions like Asia, notably. And I think Mike is quite right that over time, Asia, which is generating surpluses in many cases, Asia is going to be not just self-financing, but financing other parts of the world. But we're not there yet. And we're not going to be there for whether it's 5 years or 15 years, I don't know. But the markets have to grow up.
So how much of your global portfolio is now in Asia, David?
For us, it's about a quarter of our portfolio.
Same as Jonathan.
About the same, I guess. We're about 60% in the US, about 25% in Asia, including Australia in our case.
Okay.
And the rest miscellaneous places.
Okay.
Not much in Europe,
Okay.
Which we have tended not to like.
So everybody seems
Christine, that's my point. So you think about MSCI index. You look at public markets. There's no way anybody has 25% of the portfolio in Asia. Right? You're lucky to have 5 or 6% MSCI, probably 3 or 4%. You look at private capital, there's 25% of portfolio in Asia. And I think even though all of the gentlemen are looking for much the same stuff, their capacity to deal in markets where you don't have the same quality of infrastructure is better than the public markets. And therefore, in the transition, I think you'll see a lot more private capital being willing to, albeit with all of the, handling India, handling China, still put more money to work than public market money. And one of the challenges in Asia is, frankly, the geopolitics. In the US, to make your point, 80s, one country. So, the markets can develop. Europe, it took 50 years, but, the snake, Lamfalusi, etc. But by and large, they have a common regime. In Asia, the big challenge is, I've been on the group of experts to the ASEAN Capital Markets Forum since 2007. I got to tell you, 7 years later, it's a very, very, very glacial pace. Just getting harmonization,
no one can agree.
Commonality of rules, just getting people to agree to do prospectuses in English, right, and to come to a common this thing. 7 years we haven't been able to get agreement. So I'm not holding my breath in terms of how quickly you will get commonality and therefore deep and depth that you need in the markets.
I think you sometimes forget in the United States that we had many of these challenges. Institutions, insurance companies, for example, could really never sell a bond in the 1960s or 70s, early 70s. You had to get information in place that allowed them to buy and sell debt. Insurance companies, for example, in convertible markets, couldn't decide whether it was a debt or an equity, so they concluded that they only could buy it on the new issue. They couldn't buy it in secondary markets. So it took quite a while, a number of years, to put this in place. But the advantage Asia has is the ability to take the best of other financial systems and markets and not take the worst of those markets.
I was about to say.
And so the potential here to finance, when we think about Japan or China holding $3 trillion or more of US government debt, it's only because where are you going to invest in the world? What market can you put $3 to $4 trillion in without substantially moving a market? Well, if you created debt markets for infrastructure in Asia and other things that were large enough, then these large capital pools wouldn't have to go to other areas to finance them. And so the potential here is you need leadership, but it should be substantially easier here than it was when it didn't exist in the United States.
So I'd just like to make an add-on point to Mike's, which is we do a lot of financial services investing. We've been in banks or non-bank lenders of one sort or another in 7 or 8 different markets here. And we found the regulators to be quite sophisticated. Sometimes they don't have the right legal formats, but the regulators themselves have tended to be well-educated and rational people, which is more than I can say about the US regulators.
And I would second what David said. When I would compare maybe those discussions in the 80s in Japan with the discussions in China in the last 4 or 5 years, they fully understand these issues. Now, whether they're going to be capable of dealing with the fact that these are largely held by the government banks, and they might have a great deal of difficulty competing in an open marketplace for ability, for talent, etc. But I think many of them are very sophisticated in financial markets. And if I think through the parts of the capital structure that Jonathan was indirectly referring to, it is sometimes that your most senior debt is actually equity, and sometimes it's senior debt. And so as you structure, whether it's preferred stocks or convertible bonds or mezzanine or different forms of building a capital structure, the question is, do you have the marketplaces here that can take it? I truly believe you have the capital. the wealth in Asia. And if you look at the history of markets, now that more than 50% of the world's economy is outside of the United States, Western Europe, and Japan, the potential is here. It requires leadership in the regulatory sense, but leadership from the financial institutions, and a commitment of capital to secondary markets, and a commitment to technology, so that Jonathan feels comfortable that he can finance these businesses whether the sun's out or whether it's raining, in these different markets.
Yeah, I'd like to add a point that to what Piers was saying about market development from our own experience. So he talked about the public markets not offering the kind of liquidity or products that investors need. And that's very much the case indeed. If you look at, let's say, MSCI consumer stocks, right? So if consumer trend is a big story, you like to be able to own some consumer vehicles which take advantage of that. But it's 8%, right, of the index within emerging market. So what it means is that a lot of other parts of the public markets are not giving you the right kind of vehicles to put money to work. We have had to gain some of those exposures indirectly, through MNCs, companies listed in the States, in Europe, which in itself may not be a bad thing, right? That could well be a better vehicle. But longer term, it does mean you are restricting the development of public markets if these companies are not able to find room in the public market space. So I think practically investors have to look for the vehicles outside of the region, as well as to do more private markets, which speak to what Piers was saying.
Okay. You brought up a good point, Mike, which is, what can Asia adopt? What models can Asia adopt that could be the best for the region? Let's explore some of these structures and these models. Should we look to the US? How much should we look to the US? What should we get from the US? And to what extent should Asia develop its own structures, its own capital models? Any suggestions, any ideas on how we can push this further here in the region?
Well, I don't know about structure, but I guess 2 points I want to make. One, I think asset-backed financing is very important in Asia. So it's actually quite ironic that in the aftermath of the GFC, the notion in the US is that markets were too sophisticated, too advanced, securitization is not good, you need to rethink the whole capital allocation against securitized assets. Is completely different from what we need in Asia. In Asia, the truth is the markets are underdeveloped, and if you're going to finance Asia's infrastructure, you do need asset-backed financing, whether it's mortgage-backed, whether it's all kinds of infrastructure-backed bonds. So developing a robust asset-backed infrastructure and a range of products around that, I think, is extremely important. The other thing which goes in hand in glove with that, and Jonathan talked about the FX risk and so on, as you get duration, you need deep swap markets. Right? And so to be able to get the swap markets and get some liquidity and depth in swap markets is actually going to be quite important. So my second point, and maybe this is not, but I'd like to come back to that. I think one of the silver linings I see is the internationalization of the renminbi. If you look at the growth, the one area where we've seen significant growth in the private bond markets, including high yield, Mike, to your point, is in the offshore, the CNH bond market, the offshore international renminbi. I think if there's enough issuance coming out of China, which is renminbi denominated, that might create an impetus which actually extends.
So you think China will lead the way? China should provide the leadership?
Sure. If you think about the corporate bond market, I said, the bond market in Asia is about 5 trillion ex-Japan. About 2 or 2.5 of that is corporate bonds. The largest chunk of that is already China. It's 1.7 or 1.8 out of the 2.5 trillion is the Chinese private sector market, right? And growing rapidly. So the issuance, the dim sum bond issuance, not only into Hong Kong, but now into Taiwan, into Singapore, coming out of Chinese issuance in renminbi has been very, very rapid in the last 2 years, last 12 months. So I do think there's an opportunity on the back of that.
Okay, so to what extent should China lead in the growth of capital markets here in Asia? Jonathan, do you have your take?
It is interesting. I think it was just last year that in China, their corporate debt market eclipsed the US in size, so it became number one. But we don't think of it as developed. We think of it as opaque and some government controlled. I actually think it's somewhere between unable or unwanted to actually copy the U.S. system. In other words, we tend to think of the U.S. system as, well, it is actually, as we sit here, working well. I mean, that's a separate debate. But by world standards, it's held up very well. And it's based on transparency. It's liberalized. Banking has been largely disintermediated. And some of us, including at least two here, David's firm and our firm, has stepped in as a direct lender where banks used to participate. I have to believe that was the goal of regulators. They knew exactly what they were doing about eliminating the dependency on banks, or for whatever set of reasons. The outcome was achieved. It wasn't unexpected, I don't think. My guess is that in China, for example, where the top 5 banks are state-controlled, their goal is actually not, I think it'd be unrealistic to think, even though it might be better economically, theoretically, to reduce the cost of capital and unleash this incredible current account surplus. My guess is that that's not their goal, and they may be exactly right about that, because what's best for China holistically is definitely not what the U.S. has done. In other words, we tend to, it's easier for me to say this because I'm American, people tend to think that this is such a good system, whatever we're talking about, when actually I don't think it should universally be applied. There are real differences in managing countries, and it's not just economic. So my guess is that they know exactly what the costs are of the current system, and will very slowly, in other words, not optimizing economics, but a range of issues, dial it up, not because they aren't sophisticated, but because they are. This is worth the trade-off. And indeed, in our space, in private equity, it actually, while it's raised the cost, it hasn't choked off the supply. Over the last 6 years, private equity in emerging markets, particularly Asia, there is more capital committed on average every year than there is invested, and it's backing up. So there's a huge supply, and generally where there's supply, it gets invested. So notwithstanding all these issues, money is flowing.
I think Jonathan, there's a number of things we can learn. One, the concept of the CLO, the securitized debt, has stood the test of time. And if you look at it on a package basis, it stood the Depression, and it stood the recent difficulties, and not $1 was lost in the AAA parts or AA parts. Now, on the other hand, the securitization of real estate had the exact opposite effect. So there are pluses and minuses from that standpoint in what we have learned. As it relates to markets, I think one of the more exciting markets that could exist fairly quickly would be a corporate bond market in Singapore, led by Singapore regulations, Singapore financial reporting, Singapore laws, in RMB. My guess is there would be substantial interest. I know from my own family office and many others, moving more of our assets into RMB into companies if we felt there was a market. Part of the creation of a market is that you can buy and sell and that there is liquidity in that market. And it requires thousands of different participants who each have their view. You know, when we think of markets being efficient, there's a lot been written on this subject. And if you're in a helicopter looking over traffic here in Singapore, you might say, boy, everyone is coordinated, they're all in their lanes, everyone is trying to maximize the welfare of everyone. You get down to an individual car level, one person's trying to get in front of another, one person's trying to get from point A to point B as quickly as possible. And I think these markets could be created. The FX issue that Jonathan spoke about, there are large money managers today that offer their clients a choice of having it indexed into euros, indexed into dollars, or indexed into gold. If you had these markets and told your clients it was indexed into RMB, dollars, gold, or euros, I think you'd be surprised how many people would actually want to do that. But in order to be indexed into RMB, you would need to have portfolios that could be in RMB, et cetera. And as Jonathan said, it's a cultural issue. The facts are that it's almost absurd that small and medium businesses and growing businesses in China have to go to the United States to be financed when there's so much excess capital. So the Chinese government finances the U.S. government, and U.S. investors finance Chinese businesses. And they're paying a premium in rate for that. And so in the interim, I think the market would accept Singapore today quicker than it might accept China as from this standpoint if there was cooperation. And a lot of the companies in China could finance here in Singapore today. I mean, as a short term, I see that as a great potential for markets with some leadership. And now that TPG and Providence both have financial arms, that we can give our own money from my family office to both of them to manage in that area. Yeah. Maybe you can help.
We could use your help too, because it will be interesting to see how long-term bond rates are actually developed when you don't have benchmarks, because most of the big economies here are running surpluses and the governments aren't borrowing long, so we don't have those long, those benchmarks that we're so used to in EU and US. And Mike will help that market here figure out a good proxy for that. But it's essential for investing for us. I mean, it is one of the, you know, it's on the list of constraints right now, is credit. And it's more than an exchange, it's also law, it's creditors' right. There's a whole body that comes with it, which I think on a theoretical level, there's a willingness to pursue it. The question is the gap between the theory and practice. It's been so far hard to get us over the hump, but it's not because folks don't recognize it, who are in the position of making policy.
But we, you know, we've made the decision in our own family office to invest in the Singapore dollar for the last 10 years, and it's been a good decision. And I think our decision is that we're going to be here long term.
So, Michael,
I'd like
to make one point here, which is the round trip that you pointed out that's occurring with the Chinese taking their funds, excess funds, and buying treasuries, and the U.S. investors taking the proceeds and investing in Chinese companies is not a mistake, it's a strategy. Because the Chinese are taking treasury risk, and the U.S. is taking Chinese private company risk.
You're talking about Alibaba?
Well, there's a good example. Alibaba is probably has the worst governance in the history of the world. In fact, Alibaba doesn't own anything. They're dependent on Jack not to steal anything more.
So does that mean you won't put money with Alibaba?
No, I love it. Just like the rest of the
Would you put money with Alibaba?
How much?
Come on,
that's
Jonathan.
not the right question. The right
No,
question,
actually,
did you get an allocation or not?
So the point of it is that investors are willing to overlook what you would consider in many ways in a developed market a deeply flawed structure.
Right.
If we came to Providence and TPG said, we got a great deal for our investors, right? Jonathan Nelson can walk out the door with all of the proceeds any day he likes, but give him the money and trust him, you wouldn't do it. Well, maybe in John's case you would, but in most cases you wouldn't do it. That's exactly the Alibaba structure, right? So have at it, guys.
But the interesting thing, to Jonathan's point, you think about the challenge, one of the challenges, actually you have benchmark. So Temasek issues 40 years, for example. Yeah. The problem is you don't have a rating scale. And therefore, issue a rating from China, how do you compare it with the credit rating of an issuer from Singapore or from this thing is very hard to figure out, given there's a lot of opacity in how the issuer ratings are. Interestingly, that notwithstanding, and David's got the right point, a lot of people are willing to put money in the last 12 months, the amount of high yield issuance out of China, property, in a sector which everybody is concerned about, but high yield property issuance from China, which gets financed in the Hong Kong and Singapore market, is extraordinary. So people are willing to take some kinds of risk in these markets which they might not normally be willing to take. And I think that's your point. I think that's a good point.
I think also we're fully aware of today that the covenants have fallen by the wayside. Now, this is a positive for both Providence and TPG.
I think
and
that's
maybe
great.
even-
I think that's a great advancement in capital credit markets.
But that's a cycle also, and I'm sure the GIC and their
Yeah.
direct investments has
So
benefited.
Chowkit, you have your ears very close to regulators here in Singapore. I mean, Mike brought up that it would be nice to see a Singapore corporate bond market in renminbi. Would that be something you think Singapore will be interested in? What are you hearing? You think,
No, Christine, just for the record,
Yeah.
we have a lot of renminbi issuance in Singapore.
Yes.
It's not a
Yes,
new
that's
idea.
right.
It's just Hong Kong, the deeper market.
Yes.
That's right. I think, the idea of establishing a government curve,
Yes.
I think is a very useful one. If you look at the history of almost all capital markets, you start with that, right? So that you can have something that you can price against. So I think it will be a good thing, and it will be good for Singapore to develop that. But just to be...
How long will it take?
How long will it take? Well, it takes the issuer and it takes, the investor. I think, as Piyush said, there is already a market developing.
Yes.
So I don't think that, will take a whole lot, to develop further.
Well, one of the problems in terms of liquidity, of course, is unlike the US, where the government needs to borrow a lot of money, in Singapore, the government doesn't borrow any money. We're in a surplus situation. So any issuances that the government makes are only for purpose of creating benchmark. And benchmark is you just don't need the money. And therefore, supply of paper, government paper at least, tends to be very limited.
Okay, another point I want to make, of course, is when you compare to the US and Asia, state-owned enterprises make up a big bulk of the capital markets here in Asia, unlike the US. Do we need to see a big boost, a big growth in private enterprise, private companies, small and medium-sized companies to get these capital markets going? And how do we do that? Any ideas?
Depends on which portion of the capital markets you're talking about. If you're looking at the business that Jonathan and Providence and myself and TPG do, the answer is that you could do many more things if you had an economy which wasn't consistent of largely either family-owned businesses or state-owned businesses. But if you're looking on the debt side, it's entirely different because companies that are family-controlled or state-owned enterprises still need to raise money in the capital market, still need to make debt issuances. So it sort of depends on which part of the market you're looking at, Christine.
I would say in the public market in the United States, it wasn't until really about 1979 or 1980 that we started to finance private companies in the public market. So whereas they were wholly owned by a family or a group, you began to sell debt in private companies. And in effect, companies owned by the private equity firms are private companies with often the debt financed in public markets. I think one of the reasons that Asia has developed so differently with large family-controlled businesses is there really wasn't these markets to finance in. So if you're a talented entrepreneur and you have ideas and ability, are you going to get access to capital? If you're not getting it from your family, where are you getting that capital? And the more effective development of markets, one of the things we saw in the United States was as these markets developed, the tremendous change in job creation between smaller and medium businesses with people with talent and access to capital on an even playing field really opened the market. So if you looked at the job creation, you would see this began in the 1970s, but it really didn't open up till 81, 82, 83. But once that occurred, job formation fell off a cliff in large businesses and job formation. So where are the next 1,000 entrepreneurs who don't have family money that want to have a better idea of a business? Who's going to finance them? What are the markets in place that can allow them to succeed? This will make the businesses more competitive, and over time, it causes challenges, and I still have a few thousand arrows on my back, but when you force existing companies out of business because they can't compete with new technologies, they don't go down easy. They're going to the government, they're going to the regulators, they're trying to figure out anything they can do to stop the flow of capital to those businesses. But the potential need for job creation in Asia is so significant and the growth of businesses, that it's being held back by the fact you don't have these markets in place. And many of the best and brightest never have that opportunity here to form their business because they don't have access to capital.
Actually, one thing which I think could happen, I can't say for sure, is given what I think is a real challenge of getting this alignment of interests across countries in traditional regulatory forms, I do think the internet and more modern forms of capital raising, so crowdsourcing, the Kickstarter equivalent, might actually gain pace in Asia quite rapidly. It allows you to create a participation process which can skirt the traditional boundaries of regulation, if you will. And it'll be interesting to see if that does happen.
Well, you've commented to me when you asked me who could be your major competitor. 2 to 3 years from now, it could be Alibaba.
Alibaba already is. It's my number one competitor.
And so where is capital coming from? One of the things that in our studies that's really been interesting is how the individuals trust many of these companies on the web. Obviously, people are putting up all their deepest, darkest secrets on Facebook for only a couple billion people to see. And so I think there was a period of time when you had money, you wanted to go look at the vault. You didn't want to just go see the bank. You wanted to see the vault that it was safe in. Now people are willing to move their entire net worth on the internet with the trust that it's getting from point A to point B. And I think the point on crowdsourcing, collecting small amounts of money from large numbers of people, billions of people, and then trying to figure out who's going to invest that money. I think technology is going to play a significant role. And it's somewhat scary. We've been very focused at the Institute on the area of crowdsourcing and finance. Who's doing the due diligence? Where's the due diligence on these investments going? The first finance, when we talk about Kickstarter, many people, they'd be happy just to get a T-shirt. So if you want to get your movie financed, you've been able to raise money. You really don't own the movie, but you will get a T-shirt if you put up money. So this area is going to grow quickly, and there's a lot of challenges to it.
Jonathan wants to jump in.
Yeah, no, it wouldn't be surprising if this sector, financial services, doesn't mimic other sectors where emerging markets lagged, but in the end leapfrogged developed markets. For example, in spaces that we happen to focus on, we saw it in telecom where landlines were woefully underdeveloped, and then that worked out just fine because along came mobile. So you skipped the whole inefficient investment in fixed lines, particularly in rural settings, put towers up, and you have mobile. We're, I think, about to see that in content and media where they're woefully behind in Asia. While they have good networks, they don't have the
So that's an area you're investing in?
Yeah, it's interesting, but I think what may happen is they're just going to go right to the next, digitally distributed. That could happen in financial services too, because they'll take the best of what's worked in the US, for example, which I hope is not Kickstarter, because I think in the end, real money in exchange for T-shirts is not a long-term solution for investors. No one in this group. But there'll be other disintermediation of banks that are more efficient than what we look at today as best examples that will be glommed onto here. In the meantime, it may be less of an issue than it appears because, first of all, money is flowing because growth rates are high and that attracts investors. Whether it makes sense or not, they're coming. And the currency, if you will, and I don't mean FX sense, that high growth is compensating for the frictional cost of raising money here. That's what's making it work right now. And so better solutions would reduce cost of capital, and that has a benefit, but it's not as if growth won't continue, and that cycle, eventually it'll converge. But we're a long ways off, I think, from, at least in the world that David and I operate in, that GDP, absolute GDP, correlates with private equity investing, for example, because it'll take a long time for these systems to be fully developed and for the needs to come into play that we look for. But it's not as if capital won't flow.
Well, it's also the case that we don't, as you made this point, I think, a bit earlier, we don't invest in GDP. You invest in earnings. We're company-driven in our business, in the private equity business. And it's one thing to have an economy where the wind's at your back, the economy's growing nicely, that's obviously helpful. But the fact the economy is growing well doesn't mean that a particular business is doing well or vice versa. And it is also the case, to Jonathan's point, that we do see a lot of leapfrogging. If you look at, say, internet banking, the leading banking platform in the world in internet banks in Kenya, of all places, which is not exactly a place you'd think of would be a harbinger of new ideas. But because they had no infrastructure, somebody in the banking business figured out how to use mobile banking before anybody in the West did. And to another point that's been made here, these new businesses are generating lots of jobs, but they also cause lots of controversy. And the nature of life is that the existing businesses don't go easily, and they go to the regulators, they go to the markets, and they do their best. We have an investment in Uber, which probably has a fight in 140 different cities of the 140 cities that it's in, all of which are led by the taxi industry, which doesn't like what's happening to it, and you can understand why they feel that way.
Perhaps, put in a plug for infrastructure, something more brick and mortar, instead of just, all the virtual stuff, which of course is hot these days. So last night, DPM Taman talked about that, the need for infrastructure investing. I think that's one area that private capital can play a big role. I think in Singapore, we have World Bank, we have the IFC coming here to set up shop. We participate in one of the funds, we second some people there, try to work with them to develop this sector. Perhaps that is something that if more investors get involved, we can actually create a market that is very big. Right? I mean, the amount that is needed to go into infrastructure is just tremendous. So that's something that actually many investors can play a role. And as long as we get the supra involved, the government involved, we get the pipelines there, I think there, we could start something very much bigger, say, in 10 years' time.
So infrastructure is a big theme of yours when it comes to GIC.
Certainly.
But by the way, I completely agree. That's a good example of where credit market capability is essential. You need long-term credit for long-term projects. And the bond market that Mike described is, I think, part of infrastructure investment that needs to happen kind of around the world. That's a global phenomenon, not just emerging markets.
I mean, the U.S. needs infrastructure, and I would really second the point that was made here in that the ability to finance infrastructure, it takes an expertise. And there are firms that were the first firms to do railroads and railroad cars, et cetera. And once you've gotten that expertise, whether it's ports or railroads or whatever it might be, that expertise can be based anywhere in the world. It could be based in Singapore, et cetera, and then apply to different markets around the world. And the United States probably needs as much infrastructure as anyone today to be rebuilt, and maybe we'll get it financed here in Asia.
It'll be the other way around for a change.
Well, infrastructure faces a particular challenge. Obviously, there is a worldwide need, and there's whole continents like Africa which are woefully short of infrastructure, and there's lots of demand. The problem tends to be that the returns are low by private equity standards, and they take a long time to mature because you have to start, at least in the greenfield situation, you have to start with a plan. You have to get approved by usually different layers of government regulators who may not always be on the up and up. Then you've got to actually build something in some fairly obscure location, which is not easy to do. The Chinese have been experts at doing this, but they aren't return-driven. They're policy-driven. And you've seen a lot of infrastructure And anywhere in Africa, go look at the Chinese companies that are building the infrastructure, and it is almost exclusively Chinese companies. As I say, it's because they're not return driven, and it's very hard for guys to accept the kinds of yields that people will take for policy purposes.
We talk a lot about...
And regulation doesn't help. So, the Basel regime for insurance companies, Solvency II, makes it punitive to finance long-term infrastructure projects. And, given insurance companies want duration, that's a shame. And for banks, the liquidity regimes make it very, very hard to put money in long-term infrastructure projects. So it is a challenge.
So as financial markets here in Asia and capital markets here in Asia develop and they start to deepen, what role should financial regulators, policymakers play? We've seen increasing regulation in the US. I'm guessing that you guys don't think that should happen here in Asia. How much is enough? I mean, how much should policy regulators spur the markets, and how much should they get in the way of business? Any ideas?
Yeah, by the way, I don't think that we get up in the morning and say regulators are bad. There's smart regulation, there's good regulation. We've just seen a lot of bad examples, but actually it can be really helpful. I mean, all we're really after is fair play, predictability.
Are you getting that here in Asia?
Excuse me?
Are you getting that here in Asia?
No. We're not getting it that well in the US either, to be blunt about it. But it is, it's the front line of government policy. Their boss are generally government. And if they either turn a blind eye, or it's confusing, or it's corrupt, it just reflects the government. And I don't think that they are, and typically, they are actually sophisticated. They understand better, this is in many markets, but they're guided by a different mission than the one we're after, which is a level playing field based on real economics with known boundaries, as opposed to discussions in a room off-site that's different for each player. I'm putting that nicely. So that's actually not a problem by itself. It really depends on the wishes of the government policy. And we've seen this play out. That's a global phenomenon.
Any ideas on what role governments and policymakers should play?
Well, that's a very narrow question.
Silence means a lot of things these days. Piyush?
Obviously, there are lots of regulated industries. We invest in lots of regulated industries, in financial services, sometimes in media, sometimes in transportation, particularly airlines. And as Jonathan says, regulation is uneven. Some places you have really rational regulators driven by sound policy judgments. Other times you have regulators who are less intelligent. If you look at the banking sector, we just bought a bank in Sri Lanka, and the central bank there was, I thought, quite forward-thinking and relatively easy to deal with. On the other hand, if you go slightly to the north to Reserve Bank of India, under the last regime, they were almost completely driven by xenophobia and unwillingness to let foreigners invest in their financial sector. So and that was a more or less overt policy, made it impossible to deal with them. So there's good regulation.
So I'm getting a sense you would like to get more into India if things change.
If things change under the new government, we will be quite bullish about India, although it's going to be very hard for Mr. Modi to live up to his
You frustrated with the policy in India, Chalkya?
Lots of people are pinning a lot of hope, on the new regime. I think things are good. I would say the signs are showing, but we really have to also see the concrete measures.
What would you like to invest more in India?
Well, I think the big story for India is still, the consumer coming up, the rise of the middle class, infrastructure, energy, things like that. So I think a lot of those themes are there. It's just that the government has to unlock a lot of that capacity.
How much of your portfolio is invested in India right now?
How much? Well, it's part of our emerging market portfolio.
How much is that?
In total, it's 25%,
yes,
right, of the portfolio. So India is a small part of that.
You're testing my math here, you know that?
Could you be less specific?
Yeah, be specific.
There's room to grow.
Okay.
Could you just give us the dollar amount?
And the deal pipeline while you're at it.
I've been told we need to wrap up this session, but before we go, I would like to get a sense as Asia's capital markets develop. So much happening, so much growth here, so much wealth. How big could Asia's capital markets be? What size are we talking about? How big could it get? Can we go down a panel and guess, how big Asia could be in the next couple of years, next 10 years maybe? Piyush?
How big it needs to be. Asia's GDP collectively ex-Japan is the same as the GDP of the United States. Actually, the Asian capital markets is a fraction of the United States. So if you just use that as a general benchmark and say you need about at least as much capital, and then I would actually multiply that because I think capital efficiency at this stage of development is not likely to be as high. So multiple times of what it is what it needs to be. Now, how does it get from where it is to where it needs to be in the next 5 years or 10 years? That's a long haul.
David?
Not only is it a long haul, it's unknowable. In fact, if we knew the answer to that, we'd be out at the racetrack with the daily racing form, as opposed to sitting here talking to ourselves.
Mike, you want to give me a guess?
I think the market can grow substantially and be as large as the United States, but it needs the human capital.
As large as the United States?
But you need to get the people that have the knowledge and the expertise. In other words, to attempt to do things without the talent is a recipe for disaster. And therefore, Singapore particularly has been very successful in recruiting many of the best and brightest in the world to come here, as other countries. And many of the people from countries in Asia have gone to school in Europe and the United States. And I think, once again, understanding what not to do, particularly as it relates to residential housing, and what to do. But you need the talent and you need the government support in order to do it. But ultimately, the markets will be as large. And in fact, our view is that 4 to the 6 largest economies in the world will eventually be here in Asia. And I would be surprised if, at some point in time, the markets in Asia are not as large as the United States.
Chao Kiat?
Yeah, 2 points. One is development of financial market is an important part of the economy going to middle class and an advanced economy. So I think that has to keep up, right, for these countries to realize that goal. Second thing to say is that as investor, we, like what Jonathan said, we looked at opportunities all over the world, right? We are not necessarily confined to a particular region. So we will, of course, contribute as these markets develop.
But how big could Asia get?
It can get as big as what Piyush was saying, right? That keeps up with the economic size and as big as the U.S.
Jonathan?
I think it's much easier to predict relative GDPs than the financial sector and its size, because it's true of every space. It's not, this one happens to have a ripple effect throughout an economy, but sectors are not, don't have an equal percentage across the board. Yeah, that's what the notion of comparative advantage is, why we have international trade. There will always be countries, markets that have a comparative advantage, and that may be consistent with government policy or for whatever set of reasons. So I don't think financial sector is asymptotic to whatever GDP absolute measures are. They'll obviously increase, but who knows? And if they ever reach GDP relative levels, my guess is it'll be after our careers.
That long?
Well, I'm saying that because none of us will be around to know if that's right or wrong. So
just one final point, Christine, which is there are almost 10 times as many people in Asia, including South Asia, as there are in the United States. So in the scheme of things, it shouldn't be that hard over time for the Asian markets to overtake the U.S. markets. As I said, there are 10 times as many people. And going back to Michael's point, as people get better educated and the economies grow, it shouldn't be that big a chore to overtake the U.S.
Gentlemen, thank you so much for your insights and your views today. Can you please give my panel a very, very warm applause for their insights and engaging dialogue? Thank you so much.
On behalf of the Milken Institute, we'd like to thank you all for coming to the first Milken Institute Asia Summit. And now we would like to invite you for drinks next door at the foyer.